Hi, my name is James Boardman, and this is a part of a series of podcasts brought to you from the Johannesburg Stock Exchange. I work in the equity derivatives department, and my focus is on equity options. I'm going to be talking to you today a bit of an introduction into volatility. Now, volatility is an important part of pricing options and trading options and really understanding the options market. To do that, you have to understand volatility. So we're going to be talking you through a few aspects of volatility. So there are two main types of volatility that we talk about. One is historical volatility. Historical volatility is a pretty simple number. Everyone agrees basically what it is. You just measure the differences between one day's price change and the next day's price change. Then there's implied volatility. Implied volatility is really what the bulk of this presentation is about. Implied volatility is the volatility implied from option prices. So it's a forecast number that determines whether options are expensive or cheap, and it's the number at which people are willing to trade. It's all based on future expectations of how much the market will go up and down. So it's not whether it'll go up or down, it's how much it will move up and down in total and how fast it will do so. This is implied volatility. So it's a vital input into the Black-Scholes option pricing model, which my colleague Magnus de Wet already briefly spoke about. Now, if we look at this, we can see that I've got a slide here showing you the price change. What happens with an option when everything else remains constant and we increase the volatility? So we've got everything the same in these two options, except we move the vol up by 20%. We increase that implied volatility. So we're saying the future is going to be a little bit less certain and a little bit more bumpy. So what happens there? Our price moves from 1,985 Rand at 40% volatility to 2,669 Rand at 60% volatility. So as we can see, this is an input that you actually put into your price, and it has a huge impact on what an options price actually comes out as. So if we look at our next slide, we can see it's a normal distribution. Okay, so the normal distribution is sort of the bell curve, and it's a very common statistical tool, and we actually use quite a bit of this sort of probabilistic thinking in the back of the Black-Scholes model. That's kind of what it's doing. So we can see here that it's got actual returns for the US dollar and the ZAR, which is a Rand-dollar exchange rate. We've got the top 40 index and their returns. We can see in the middle there's a mean return of about 0. So we can see that on average, most of your returns are clustered in the middle here. That's the large number of frequencies. That's the percentage of distribution. So that's basically going up is how often it happens. So we can see that, broadly speaking, not much happens in the market. So we've got our return distribution here. This is basically along a normal distribution, and you can see that most of the time, up the left on the y-axis here, we've got how often these sort of returns happen. And along the left to right, far left events are very negative, bad returns. So we can see the worst one here for any of these returns is about minus 7.8%. So that's a terrible day. When you're invested in something, it falls 7.8% in a day, that's really not good. You see the most positive return, it's about 7.8% as well. So these are outliers. So let's just look at a distribution in terms of, I mean, one of the key things I use, I think, in giving an example on this often is heights of people. Okay, broadly speaking, you've got everyone with average heights in the middle. There are quite a lot of them. And then let's say your outliers to the right-hand side are your freakishly tall people that's sort of 7 feet tall. And then on the far left-hand side, we've got shorter people. So there are far less very short people and very tall people. Similarly, in a market, most of your returns cluster around a mean. So what we're saying with this is volatility is describing the shape of this distribution. Okay, so for a very high volatility, very, very outlandish events are going to be encompassed in that option price. So it'll have to be a truly exceptional event for you to be able to make money if you trade something at a very high volatility, because even the most bizarre sort of circumstances are taken into account. If you trade something at a low enough volatility, even a small surprise can turn out to be very profitable because you've paid such a small amount for the option. So what is volatility saying when we sort of trying to figure out this implied volatility number? For example, an example would be in insurance, because like options, as my colleague Magnus went in the previous podcast, we also trade options on premium, much like you do an insurance policy. So are you insuring this house? You can see it's in a nice neighborhood. It's got a lawn and a security sort of, looks like a safe-ish sort of place. It's well maintained. Or is it somewhere in a very run-down neighborhood where sort of the fire risk, the theft risk are much, much higher, and you've got to take that into account when you're writing your option policy. Now, or your insurance policy. So now we've got this, and we can see that in the real estate market, things change pretty slowly. In an options market, in an equity market, things can change incredibly fast. Let's look at this slide of AIG's share price. Went from being the most respected and one of the biggest US corporations to being nearly bankrupt in a matter of months. So change can happen a lot faster in the equity market than it generally does in a residential property market. It went from about $80 US to just over $1.11 on Friday, the 20th of March, 2009. So if you'd written an option on that, at sort of almost any vol, at the sort of $80 strike price, it would have been very, 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 very cheap, and the guy would have bought it, would have made quite a lot of money because the volatility would have increased so spectacularly. So let's just go back to this implied versus historic volatility. Because how do we get an implied volatility? The only thing we really have to go on is the historic volatility, which is the historical record. It's based on a logarithm of the daily movement. It's the standard deviation times by the square root of the number of days in the year. So it's generally quoted on an annualized basis. So you can compare a volatility for a 3-month contract with one for a year because they're both quoted on an annualized basis, much like an interest rate investment is. So generally speaking, implied volatility and historical volatility will move together. They move with a close relationship to each other, but often they diverge. The reasons for these differences between implied and historic volatility are to do with expectations about the future, liquidity discounts or premiums, or just generally supply and demand factors. So if we look at the next graph, we can see that there's a graph of implied volatility and historical volatility. We can see they move, broadly speaking, together. The red dot is a trade, so we can see that it starts significantly above the historic volatility, and then at a later stage, it trades significantly below. So you can see it broadly moves in line, but it does move up or down. So it's got a strong correlation, but the absolute level can differ quite a bit. If we look at the next graph, we can see that historic volatility and implied volatility both differ through time. They have a different level depending on what's going on in the market. And we can see that at a low here, sort of in October 95, the historic volatility here was quite low. It was almost 10%. And then in 97, 98, in the emerging markets crisis, you can see the volatility went right up to about 45, 47% up there. Then it dipped right down again. Then it popped right back up again further on in the aftermath of that in 1998. So we can see from this graph another very important point. Generally, most of these returns we can see are clustered between about sort of 18 and 25%. That's generally speaking for the top 40 index in South Africa, the long run average level. It's sort of the mean level that volatility tends to return to. We can see that at the peaks here, volatility became very expensive. And in the dips, volatility became quite cheap. But broadly speaking, with implied and historic volatility, there's an average long run level that it's going to return to over time. The big question is when. This is a big question with all trading. You can be absolutely right, but if you get the timing wrong, it can be quite a costly trade to put on. So what you've got to look at here is that volatility is going to return to its long-run average. So if you sold at the top and you were very brave during the middle of a crisis, you could get fantastic prices for your options. And eventually, as time progressed, they'd come back to the long-run average. You would have made a significant amount of money. The reason being that at the top, in these absolute market crisis conditions, there are people who are forced buyers and forced sellers who push the prices significantly higher to cover previous positions they've got or margin calls that they're being forced to make. So this pattern here is very important to remember. The volatility mean reverts. So whenever you're trading an option, it's a good idea to look at a long average of the historic volatility for a similar period to whatever you're trading. So if you're trading a 3-month option, looking at a 90-day volatility is probably a very good idea, that you can see what the record of 90-day volatility is, and you can start to think about some sort of mean reversion. So if it's beneath that sort of long-run average level, chances are the option could be at quite a good price. If it's significantly above it, the market will have to keep on moving and gyrating wildly for you to actually be able to make money from trading that option at a high enough price. Now, let's look at the next graph. This is the volatility skew. This is quite a curious phenomenon where options on the same underlying with the same expiry date that have different strike prices trade at different volatilities. Traders say volatilities are skewed when options of a given asset trade at increasing or decreasing levels of implied volatilities. So from this graph, we can see that at about 70% moneyness, that's significantly below where the current futures market is, which is your 100% level, options are trading at about 51%. Now, if we look at 130%, significantly above where they are, we see options are trading at about 30%. So this is a difference in volatility prices for options of about 20%. This is a huge range. We saw previously the massive difference it had, sort of a 40% price range with the same inputs on these different strikes. Now, what is happening here is that skews are driven by sort of two main factors. One is the market dynamics of the actual market. In our case, this is an equity market. We can see that puts that are out the money to protect from market collapses are far more expensive than out the money calls to ensure against market sudden rising. The reason for this is that generally when the equity market goes up, it goes up in a nice, steady, orderly fashion. When the equity market goes down, it happens suddenly and shockingly in a few sharp, violent moves. Because of these violent moves, it is far more costly to hedge these rapid movements down for option writers. So there's a natural skew due to the market dynamic. This has always been present in options market, but it became incredibly pronounced after the 1987 market crash. In 1987, the market crashed 20% almost globally in one day. This was just totally unheard of and unprecedented. Because of that, huge numbers of portfolio managers and long-only investors decided they had to insure their portfolios. So to insure their portfolios, they bought out the money puts and they sold out the money calls to pay for those puts. So they gave up some of their upside for a certain downside protection. And this drove the skew. It drove the shape and exaggerated the natural market dynamic forces of it due to the supply and demand factors, where the biggest money in any market generally is the long-only, the pension funds, and sort of these big investments where everyone's sort of long-term retirement savings are kept. So this skewed the shape, and this has created the volatility skew. The other issue is that the at-the-money volatilities are different for different expiry dates. So generally, there's a normal term structure. The most current options with the shortest time till expiry will have the highest volatility. And over the long term, when we look out at sort of 50, 60-month options, 5-year options, we're looking at volatility returning to its long-run average levels and the skew becoming less and less pronounced. Because over time, all we know is volatility will return to its long-run average level. And that's the phenomenon of the term structure of volatilities. So if we put together a volatility skew and the term structure of volatilities through time, we build something called a volatility surface, which is a three-dimensional picture. This is for another presentation sometime. So let's just look at the next presentation, which is this next slide. We've got 3 different graphs of different skews, and we can see that due to different market dynamics and different supply and demand dynamics, the Aussie-shaped skew and the Rand dollar skew and the white maize skews are quite significantly different. They're actually the inverse. The Rand dollar and the maize skew are the inverse. This is because their price dynamics are the opposite. The maize price tends to go up a lot faster. It's quite sticky on the downside. Very few farmers are happy to sell their price, any of their maize, beneath the cost it costs them to produce it. And so prices are a bit sticky on the downside. However, prices can rocket up on the upside, especially when the markets in the States move. So, and in their market, the parties with the biggest balance sheets in the commodities market tend to be the big millers, because they're going to hedge their price risk for all their bread making and chip making, and they're going to buy call options to do that, which pushes up the price of out-the-money call options, where they're buying some insurance in case prices move suddenly against them. Similarly with the rand tends to move from sort of $6 to $10 far faster than it gradually retraces its rate from $10 to from 10 rand per dollar back to 6 rand per dollar. Now, if we look at this next graph, we can see a very, very interesting and important phenomenon here. Implied volatility and realized volatility tend to be inverse to price movements. So as the index level goes higher, volatility comes down. Now we can see, sort of right about the middle here, in May we reached the heights of the market level. We've got it at about 33,500, and that's the Aussie on the top there. Lower down we can see the volatility has come right down to about 21%. Now we can see as the market crashes, volatility rockets upwards. This means that options have suddenly become far, far more expensive than they were previously. We can see the rapid period round about Lehman Brothers collapse of 15th September. Suddenly, vols took off like a rocket, and options became significantly more expensive. If you had bought put options before this period, you could have made an absolute fortune. And we did see several people who did that in the derivatives market just before the crash of 2008. Now, if we look at the next slide, we can see that markets aren't always quite as crazy, and there's a more gradualized sort of pattern. This is a more normal sort of retracement where the market doesn't move much, and the implied volatility level doesn't move much either. You can see just sort of hovering around this average level. We hope you watch the next podcast, Option Trading Strategies, and we hope you remember two things about volatility, that it's very, very important when trading options to take account of volatility, and it's very important to look at the mean reversion of volatility so you don't ever buy an option when it's trading far, far too expensively. We hope you enjoyed this podcast. Thank you.